Welcome back to the deep dive. If the digital asset markets felt like the Wild West for the last few years, all retail volatility and regulatory chaos, the landscape in early 2026 feels completely different. The phrase we keep seeing is the dawn of the institutional era.
It's a fundamental shift.
It really is.
Yeah.
So our mission today is to dig into a stack of reports we have here from Grayscale, from major market analysts, and really pull out the core insights. We need to unpack the two big forces driving crypto valuations right now.
First being that huge ongoing macro demand for alternative stores of value.
Right. And second, maybe even more importantly, the recent improvement in regulatory clarity. We're going to focus on this fascinating contrast between Bitcoin, the consolidating giant, and an altcoin, XRP, which is just surging.
And its rally is almost entirely driven by this new institutional plumbing. We're talking ETFs, bank charters, new legislation.
Exactly.
And just to set the stage for you, it's so important to get the sheer scale of this. I mean, crypto is no longer some small fringe market.
Not at all.
It has absolutely matured. It's crossed the chasm into a mid-sized alternative asset class with a market cap of about $3 trillion now. The consensus in our sources is just overwhelmingly bullish for 2026.
Okay, let's unpack that first pillar then, the macro shift. Institutional capital needs two things, right? Scale, which you just established, and a compelling reason to move out of their usual assets. So why now? What's the core reasoning?
Well, historically, the whole market has been defined by this 4-year cycle. The idea that valuations peak about a year and a half after a Bitcoin halving.
And the last one was April 2024.
Yeah.
So by that logic, we should be cooling off right now.
We should be. But the institutional view, and Grayscale is really clear on this, presents a huge counter-argument. They're predicting that the rising valuations in 2026 will actually mark the end of that cycle.
The end of the cycle pattern. That's a major call.
It's a massive structural call. They're essentially saying the whole nature of the asset class has changed.
Because the infrastructure is overriding the old patterns.
Exactly. The new institutional and regulatory frameworks are now more powerful than those old, cyclical, supply-driven dynamics. And that's why the forecast is so confident. Bitcoin is expected to hit a new all-time high in the first half of this year.
Okay, and what's underpinning that confidence? I mean, on the macro side, what are they protecting against?
It's the sustained demand for scarce digital commodities. Bitcoin, Ethereum, it's fundamentally a ballast trade against rising fiat currency risks.
The debt problem.
Specifically, the high and, frankly, aggressively rising U.S. public sector debt. When governments are having these debates about currency debasement and inflation, investors start looking for assets with transparent programmatic scarcity.
And Bitcoin is the definitive example of that.
It's the poster child. I mean, we can say with almost total confidence that the 20 millionth Bitcoin will be mined in March 2026. That finality, that absolute mathematical cap, it's just an incredibly appealing feature for, say, our large endowment fund.
The timing is also really interesting, especially with the Fed's current backdrop. Our sources point out the last two crypto peaks were, unfortunately timed with Fed rate hikes.
Which just tightens liquidity and triggers downturns.
Right.
But what's fascinating is the contrast now. The Fed actually cut rates 3 times in 2025 and is expected to keep going this year. And generally, that policy direction, lower rates, more liquidity, is like pouring fuel on the fire for investor risk appetite. It pushes capital out onto the risk curve.
It's just a much healthier setup than before.
A fundamentally more supportive environment, yeah.
Okay, so that's the macro tailwind. But institutional money is cautious, and this is where it gets really compelling for me. The regulatory clarity. What specific moves are unlocking all this institutional capital, especially for something like XRP?
You have to start with the foundational issue, the massive shadow hanging over the space for years. The SEC's civil enforcement action against Ripple.
Which finally ended. Officially
in August 2025. This was probably the single biggest hurdle for any token that wasn't Bitcoin or Ethereum.
And the resolution was key. It wasn't a clean sweep for either side, but it gave everyone certainty. Can you just walk us through what happened?
It was really a strategic retreat for both parties. The SEC and Ripple agreed to just dismiss their appeals. And what that did was solidify the district court's final judgment.
Which said?
It said that institutional direct sales of XRP were unregistered securities, and Ripple paid a $125 million penalty for that. But, and this is the critical part, programmatic or retail sales were definitively not classified as securities.
So the penalty was basically the cost of getting that clarity.
Precisely. It's the institutional seal of approval. By letting that judgment stand, the market now has a legal framework. And that's what compliance departments at big funds were waiting for.
Okay, so that clears up the past.
Yeah.
But what about the future? We're looking at this bipartisan bill, the Digital Asset Market Clarity Act. The Clarity Act.
That's right. It's set for Senate markup this month, January 2026. And the bill's entire goal is to settle these long, damaging turf wars between U.S. financial regulators.
How does it do that?
By clearly defining things like digital commodities and, most importantly, giving the CFTC, the Commodity Futures Trading Commission, exclusive jurisdiction over the spot markets for those assets.
Why is giving jurisdiction to the CFTC so critical? What does that signal to Wall Street?
Because the CFTC regulates commodities, gold, oil. By putting digital assets under their watch, the legislation essentially removes that lingering uncertainty about them being securities. It dramatically lowers compliance barriers.
So it's a rule book they already understand.
Exactly. Full passage just removes the question marks. It lets the big players operate at scale.
And this new certainty is already showing up in the financial plumbing. We saw huge news from the OCC, the regulator for national banks, in late 2025.
Yes, the OCC conditionally approved 5 national trust bank charter applications in December. And 2 are particularly noteworthy here. First National Digital Currency Bank and Ripple National Trust Bank.
Ripple National Trust Bank. I mean, that lends the firm incredible credibility. What will it actually be doing?
Well, its operations are designed for institutional integration. It'll do fiduciary crypto custody for big clients, act as a collateral trustee, and manage the reserves for their stablecoin, Ripple USD.
So Ripple is no longer just a software provider.
They are now a regulated participant inside the federal banking system. It just completely changes their trustworthiness in the eyes of risk-averse institutions.
Okay, we've got the macro drivers, the new regulatory and banking rails. So let's look at how the market is reacting in this first week of January 2026. The story isn't just Bitcoin, it's this altcoin outperformance, specifically from XRP.
Well, CNBC already dubbed XRP the hottest crypto trade of 2026.
I saw that.
And you can see why. In the first week of January, XRP surged by nearly 30%, hitting highs around $2.42. That just blows Bitcoin's 6% gain and Ethereum's 10% out of the water.
And the ETF flows really tell the story. The XRP ETFs, which only launched in mid-November, have already seen cumulative inflows of $1.37 billion. But what stands out to me is they've had 0 net outflow days since they started.
0. That's the key distinction. Now, contrast that with Bitcoin's ETFs. They saw massive demand, like $1.17 billion in inflows on January 2nd and 5th.
But then a huge reversal.
A sharp, nervous reversal. $730 million in outflows just 2 days later. That kind of whipsaw action suggests institutions are still trading BTC with caution.
So why do they see XRP as a less crowded trade? I mean, why were they buying in Q4 when the legal clarity news was everywhere?
It's about timing. The investors in Q4 were betting on the full institutional wave that would only come after the OCC charters and the ETF launch. So they were buying during price weakness, anticipating the kind of stability we're seeing now.
So the conviction is strong.
The consistent inflow suggests the regulatory risk is seen as fully priced out.
Meanwhile, Bitcoin, sitting around $90,000, has this very split outlook. Fundstrat is super bullish, calling for a new all-time high this month.
But there's a huge technical battle happening. Analyst Chiefy is warning it could be a classic bull trap. His analysis says that if that old 4-year cycle thesis still holds any water, failing to break past $90 could trigger a sharp plunge back down to $40,000.
So you have the structural bulls versus the cyclical bears, head-to-head.
Directly colliding right now. It shows institutions are still treading carefully.
Okay, back to XRP. If institutional money is flooding in, what are the price targets?
Well, the demand is creating a bit of an artificial supply squeeze. The amount of XRP on exchanges has just plummeted to multi-year lows. We're talking only about 1.6 billion tokens left.
So any new demand has a bigger impact.
A much bigger impact. Standard Chartered is the most bullish major institution right now. They're projecting XRP could potentially hit $8 by the end of 2026.
$8? Wow. What's that prediction contingent on?
It's tied directly to the institutional adoption metric. They're assuming total XRP ETF inflows reach $10 billion this year. But to really get that potential, we have to look past the trading and into the ecosystem being built around it, especially their stablecoin, RUSD.
And this is where we get to the risk, the utility disconnect.
Yes. RLUSD, their compliant stablecoin, is central to the whole enterprise strategy. It hit a market cap over $1 billion in late 2025, helped a lot by the Genius Act.
Which set up a federal framework for payment stablecoins.
Right. And now RLUSD is scheduled for full deployment across Ethereum Layer 2 networks like Optimism and Base in Q1. They're using the wormhole standard, which just means it can move seamlessly across different blockchains.
What's the synergy between the stablecoin, RLUSD, and the volatile asset XRP?
The idea is actually pretty elegant. RLUSD acts as the stable accounting unit for payments. Then XRP provides the instant, super efficient liquidity bridge between currencies. It potentially solves the volatility problem that's always scared institutions away from cross-border payments.
And Ripple is all in on this regulated path. They're staying private, growing through acquisitions.
Exactly. And they're accelerating their global footprint. They just announced collaborations with major players in Japan, Mizuho Bank, SMBC Nikko to push XRP ledger adoption across Asia. The focus is squarely on enterprise.
This all sounds like a home run, so why are you hinting at a disconnect?
Okay, here is the critical aha moment that you really need to internalize. Despite all the regulatory wins, the bank charters, the ETP inflows, a huge execution risk remains. The utility disconnect, daily active addresses on the actual XRPL network.
So actual usage.
Actual usage. It plummeted 94% from 600,000 in March 2025 to just 38,500 by December.
A 94% decline.
Right.
While the price is soaring and regulatory certainty has never been higher, that is a massive red flag.
It is the gap between institutional interest and on-chain execution. The implication is that banks might be using RippleNet for messaging or reconciliation, but they may not be actively using the XRP token itself for on-demand liquidity.
Which is the core value proposition.
It's the whole point. The market is valuing the token on the promise of adoption, but the data suggests actual token usage is extremely low.
So institutional interest is wide, but token usage is narrow. That's a huge risk if the market eventually demands utility to justify the valuation.
Precisely. And adding to that, early investors, the whales, have been taking profits. We saw $721 million in realized gains in late 2025. They're using this new ETF liquidity as their exit. And that selling pressure can absolutely cap rallies.
So if we step back here,
The fundamentals, the regulatory clarity, the institutional investment, the ETPs, they've never been stronger for the space, and especially for tokens like XRP. But we have to acknowledge this core conflict. The market valuation is running way ahead of its proven sustained transactional utility.
so what does this all mean for you as you're trying to make sense of this new institutional landscape? The story of 2026 is this institutional pivot. It's about which assets can actually bridge that huge gap between traditional finance credibility and proven on-chain utility.
That's the billion-dollar question, or I guess trillion-dollar question now.
It really is. And that leads us to our final provocative thought for you to mull over. The institutional era promises to draw much sharper lines between crypto assets. If regulated firms start demanding that tokens show sustainable revenue, meaning real transaction fees from real utility, what happens to high market cap tokens that currently have a significant utility disconnect? The regulatory wins might just be the starting gun for a new race, a race to demonstrate genuine token-driven utility. And that is the critical question the market will be answering as the Clarity Act moves forward this month.